Hi, everyone. Thank you for joining us today. I'm Marcia, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're so excited to bring you this educational presentation today. Attendees are muted, but we encourage you to ask questions using the chat box, and the presenter will address those queries during a question and answer period at the end of the presentation. If you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question, we will make sure someone reaches out to you to make sure that we address your question after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion on the material. I'd love to introduce you to today's guests. Our moderator today is Guy Tomasi, and he is the Director of Financial Planning at Holmes Investment Management, Inc. He has 20 years of experience in all aspects of financial services, focusing on comprehensive financial planning for the past 10 years. He holds a Bachelor of Science in Finance and Accounting from Bridgewater State University and has a postgraduate certificate in financial planning from Boston University. Guy is a certified financial planner. He also has his Chartered Retirement Planning Counselor designation and his Chartered Mutual Fund Counselor designation from the College of Financial Planning. And Guy, come off of mute and say hello so everyone can see you.
Hey everybody, how you doing today?
And Guy will be handling your questions, moderating those, and so he will see you in the chat. I'd love to introduce you to today's, I'm going to go ahead and mute you there, Guy. Great, thank you. I'm going to introduce you to today's speaker. Howard Holmes is the principal of Holmes Investment Management, Inc. and an investment advisor representative. He is a chartered financial analyst charter holder, has a Master of Science in Finance degree from Bentley University, holds a certificate in advanced management from Babson College, and a bachelor degree in economics from the University of Massachusetts at Amherst. Howard teaches part-time graduate courses in finance at Boston University and has been a grader for the CFA exams. Howard is currently enrolled in a doctorate program in business at the University of Rhode Island. Teaching has been a major way Howard gives back to those in surrounding communities and develop the future generations' love and understanding of finance. And I'm going to go ahead and stop sharing my screen here, Howard, and it'll be your turn to take over and share your screen, and we'll get going.
Okay, very good. Okay, hello everybody. I'm very happy to be here with you today. We're going to be talking about option trading, and I think throughout the presentation there really are three themes to keep in mind at all time. One is the expected projected return. Two is the risk. And three is the tax liability. Today, we're talking really about practical option trading. As you can well imagine, the topic can be very academic and theoretical, and mathematical. That is not the intent of today, but we will show you a resource where there are formulas, equations, and frequently asked questions for those of you who are interested in a delta, a Black-Scholes, etc. Please do ask questions and through the chat box, and we will answer your questions. So some other resources are really good resources for you. One is OIC. It's free. You don't need to sign up for it. And I'm going to bring you there in just 1 minute. It's OIC stands for the Options Industry Council, optionseducation.org. It gives you quotes on the options throughout the day, a 20-minute lag, but that's okay. It gives you all of the Greeks, the delta, the gamma, the theta, etc., completely free. The second one is the CBOE, which is the Chicago Board of Options Exchange website. And there are talking about webinars, there's so many webinars on everything there. It's wonderful. Another one is a service I use. It's called Bar Chart. Now, if you do need a subscription here, but it's very low. A fourth one to be aware of is market volatility, either at the S&P index, which is the VIX, or on the NASDAQ, which is the VXN. And then a third, I've lost track, sorry, is on our website is this link, gives you a list of formulas and frequently asked questions. Again, what is delta? What is Black-Scholes? What is gamma, etc. Okay, so the agenda for today is to know. It's very important to know what the goal is. We don't just randomly trade an option. So we want to model, everything is modeled. We model the risk and the return. And the way we do this is actually different than a stock or a bond or a mutual fund, quite different actually. We would need to understand the broker, whether that be Fidelity, Schwab, wherever, the margin requirements. And because options are what's called non-marginable, we actually call it the non-margin buying power. We will be, so also to trade options at any broker, you need to be approved and you need to be qualified. Guy will elaborate upon that in a little while. And we want to talk a little bit about a margin call. There's a movie out there actually about margin calls. I don't know if any of you have seen it. It's a wonderful movie and it's a great movie. I don't want to put that much fear into you, but there could be margin calls and we will discuss a little bit on how to deal with that. C, how to manage risk. And there are two ways to do this. One is possible risk, which, I mean, it is possible that we have another 1929 stock market crash where we lost 90%, went into a global recession leading to World War II. But that's very unlikely to have a 90% crash. So what we really what's more likely is a probable risk. And that gets into probability, and it's very easy. Identify the best strategy. As you probably know, there are many option strategies. We really are only talking about one today, which is the short put. We are shorting a put, and I'll explain what a put is. I'll explain what shorting is. Then we're going to model the portfolio. we're going to try to understand that when you hopefully make all the money you make, the one drawback is it is in a taxable account, it is a capital gain, and it is a short-term capital gain, which means the tax bracket, the tax rate is higher. We're going to do a sample trade, and we're going to discuss the probability of success. Okay, a little bit of, some of you may know this, or it might be a refresher, it might be new, I'm not sure. So in options, there are two types of options. A call option allows you to buy an underlying security, like a stock, at a particular price on or before a particular date. A put option is the reverse. It allows you to sell a stock like Apple on or before a particular date at a particular price, and that particular price is called the strike or the exercise price. That's what we're working with, is with puts. But we are not buying puts, we are selling puts that we don't own, which is called the shorting. So I'll get to that in one sec. Expiration, another word for expiration, if you ever like trade a bond, is maturity. It's the date at which it expires. The premium is when you buy or short the option. It is the, in this case, the money that you receive. Remember that when you buy any security, you do it at the ask quote. When you short the security, you do it at the bid quote. Now, short means that you sell something you don't own. In this case, you maybe have heard about that for stocks, but in this case, what we're doing is shorting put options. Okay, margin. Margin can mean different things. The most common definition is when you buy additional stocks and it's a loan, but that's not the case here. It's a collateral. We are shorting options. It's a collateral. There is no interest cost to this margin. It's not a loan. It's only a collateral. The collateral formula is established, but it changes all the time. The margin call will be triggered when the margin requirement set by the broker exceeds the non-margin buying power. So I'll address that for 1 minute here. Often, most of the time, you don't need to do anything because the market will correct, it'll move up, and the margin call will probably go away all by itself. Usually that is the case. That's not always the case. If it is an option margin call, you probably have about 3 days, though, to either have it go away on its own, or ultimately you might need to add money to the account or liquidate some positions. But you don't need to rush into that action. The strike price is, again, the price at which you buy or sell, or it's known as strike or the exercise. Now, in option trading, risk and return are very, very important. So risk really is, in a way, considered two different things. One is loss of principal. You can lose money. And two is volatility, like a standard deviation. The risk of option trading, let me be really, really clear, is higher than the stock market. The return is very good, but the risk is higher. So when we talk about two types of risk here, the implied volatility is the volatility on the option. And I'm going to show you in a minute, like where I get that. The historical volatility refers to the stock. Let me actually show you right now. Okay, this is, can everybody see? This is OIC, optionseducation.org. This is on the Triple Q, which is an exchange traded fund for the NASDAQ. And right, if you can see my cursor, you can see the implied volatility. Every single strike price at this expiration, August 20, has a separate implied volatility. That is a measure of risk for the option. Now, if we go down to the bottom of the screen, you'll see over here, 11.47. That is the historical volatility of the stock. There is often a correlation between the two numbers, and there is an interpretation if one exceeds the other, but that's probably not something we'll necessarily win to right now. Return. Now, the return is as small or as big as you engineer it to be. That might sound a little strange, but you can be as risky or as conservative as you're comfortable. But I would say we target returns in the 70 to 100% per year or annualized returns. But
can I just break in here? So this is what your firm, that's kind of your benchmark there. Although with other firms, it's going to be different and depending on their strategy.
Absolutely. And to build on exactly what you just said, this is based on the Triple Q. The Triple Q is riskier than the stock market, but it is one of the most conservative options we do. So I'm going to tell you two others. DAQ, not Dairy Queen, DAQ is a Chinese solar energy stock. The return on it is about 250%. And in fact, if you watched it yesterday, the stock itself went up 20%. And that means we went up a massive amount in one day. Another one that we work on is Square, which is an American fintech financial firm. I think the return there is about 150%. So, Marche, you're right. I mean, you are the firms, and we use multiple stocks too. This is a base case for the Triple Q. How do we measure return? So this is not universally understood. It is the profit divided by the margin requirement. So it's a nice simple formula, but it is and it isn't, because we need to project each. And as I mentioned, the margin requirement changes all the time. If it goes well, the margin requirement will contract, it's smaller, and then therefore our ROI, return on investment, will increase. Hold on a second.
Yeah, there
Okay,
we are.
yep, okay, sorry. Okay, so the returns are on a margin-based methodology. Return over margin. the concept is simple, the calculation and medium so. And then we annualize it. So we typically do a 30-day position, but then we annualize it. So we do that with every security. Even if you have a 6-month bond, it's annualized to 1 year. If you have a 3-year bond, it's annualized to 1 year. So we are consistent there. Okay. Now, probability of win. You either win the position or you lose. And you don't need to have a doctorate or PhD or master's or anything in statistics to do this, to calculate the probability. It is simple. And we're going to do one together. All as you do is take 1 minus what's called the delta. So if the delta is 0.1, 1 minus 0.1 means that you have a 90% probability of winning. So let me now go back to OIC, and the delta is right here, right under the column delta. So if I go down, if I pick this option right here, which is the 334 strike price, 1 minus 0.1 to 0.10 is a 90% probability that we will win the position. Very simple math. There are measures of volatility, which I mentioned before, the implied and historical. And it's very important to be aware of, to monitor the VIX and the VIXN. I would say right now, they're both in the low 20s, which is okay. It's very good, actually, because the markets are pretty good. In a really, really bad time, you can look it up on Google, see a graph. A really, really bad one is when it's in the 80s. Then you know there's a problem. But right now, everything is pretty good. The implied volatility of the QQQ is in the 28% range, and the returns are ranging from 59 to 86%. And when I say this is a low risk strategy, in the world of shorting options using the QQQ, it's a low risk strategy, but it exceeds, let me be clear, the risk here exceeds the stock market and other riskier option strategies. Now we want to talk about the margin requirements and what we need to do to manage option trading with the broker. So I'm going to ask Guy to jump in, and Guy knows this very, very well, and he helps clients get approved. Guy, would you like to discuss that?
Hey, everybody. So I'm just going to take a few minutes to talk about the eligibility process to trade options. Now, just because you want to trade options doesn't mean you can't. Okay, you have to be approved by your broker dealer or your custodian to actually trade. There's various criteria to get approved. They're typically income based and net worth based, but it varies by broker dealer, by custodian. Typically, there's levels of trading within options. Okay, so for instance, what we're doing now, it's a higher level of approval is needed to actually do this trade. Again, it varies through broker dealer. We happen to use Fidelity, so it's level 4 or 5 is what we need for Fidelity. But Schwab is different, TD is different. So we just want to make sure that you are approved to do it, because you can't just trade options because you want to. You have to be approved. And it really is a risk issue with a broker dealer. We'll see here item C. So typical account that we want to do options in, at least $20,000. Now that's more because you really, to actually buy options and the premium that costs to actually get into these put strategies, it costs some money to do that. So it's not efficient to do it on lower value accounts. So you do want to make sure that there is we recommend at least $20,000. And also the strategy that we're doing can only be done in what's called taxable accounts. It can't be done in IRAs or 401ks or retirement accounts. It can only be done in taxable accounts. I know Howard had mentioned, the short-term, or the tax liability, short-term tax liability. And the reason is because it is in a taxable account. It cannot be in a tax-deferred account. So really, I mean, that's the process for getting approved. It's really specific to each broker dealer and what their levels are, but typically it's income and net worth based.
Yeah, that was excellent. I would say most mainstream brokers offer this. The formulas might be a little different, but what is interesting is I researched the industry. I know a lot of the formulas for different companies, but I got in touch with Robinhood. You can't call them; they have no phone number. You have to email them. So I asked them what the requirement was for short puts there, and interestingly enough, they don't allow you to do this strategy there. So maybe not necessarily all brokers allow this. I don't know. I know most do, they don't. Okay, so the margin requirements, it's going to vary from broker to broker a little bit. So there, let's say at Fidelity, there are 3 formulas based on multiple variables. And then what the Fidelity computer does and what I do on my spreadsheet, it and I calculate each formula, and then we take the highest of the 3. So that is what's called the non-margin, that is the margin requirement. If you have cash in your account, cash like a money market, a T-bill, what have you, 100% of it can be counted toward the non-margin buying power. If you have equity, this number is an estimate, 70%. It could be 60%, it could be 50% if you have higher risk stocks. But the point here is, it might sound counterintuitive, but if you leave all of your money in cash, your projected return should be higher. I know you virtually make nothing on the money market, but you can allocate more to the option strategy by doing this. Now, when the margin requirement, so basically the stock or the index decreases, the margin requirement increases, and you'll get you might get a margin call. Very often when that happens, it will correct in a day or two. But what we do is watch it very, very closely, and we watch it very, very closely. And so if you do get a margin call, you don't want to ignore it. You want to manage it, but I wouldn't automatically close out the position. Now, for those of you who like graphs, this is our first graph. But what I'm really looking at is the bottom right-hand side, the short put. So there are 2 points here, really. One is that you can lose money. If the stock comes down, your put will go up, but you are short, and that will create a loss. What we do is to minimize that loss, is we have a risk minimization strategy that says we close out the position, no questions asked, automatically when the delta is between 0.35 and 0.4. So our losses are minimized. But the other, okay, that's the red part of the graph. But the green part of the graph shows that as the stock goes up, the put comes down. Remember, it's a negative position in the account. But the point is that your profit is capped. You cannot make more than what you shorted. So if you've reached your maximum profit potential 2 or 3 weeks early before the expiration, do not continue to hold it. Lock in your profit. You've met the maximum potential, lock it in, and rewrite a new position, and it compounds. Okay, so often people ask, what is the risk? What is the worst case? Well, the theoretical answer is, worst case is that the stock collapses to zero. But again, the analogy to that is maybe the 1929 stock market crash where it dropped 90%. But if that does occur, it is a very steep loss, but we wouldn't even let it get that far because of 2 reasons. One is, again, once it hits the delta of 0.35 or 0.4, we'll have closed it out before that happens. Secondarily, the margin call will have kicked in and it would have forced a sale of a buyback of the position. So, but that is the answer. It is that is the answer. The probable risk is what I'm constantly talking about here. Close it out at 0.35 to 0.4. You might have a little loss, but it's manageable. Now, and all of these formulas are modeled. The strategy that we're talking about that we do, the top strategy is what's called shorting the put. It is either a bullish or neutral strategy. So what that means is the stock does not even need to rise. If it rises, we make profit quicker, but we'll still make profit even if the stock doesn't rise. The secondary strategy, you may have heard of the straddle. A close cousin to the straddle is the strangle, and a strategy that we like is the short strangle, which is shorting the put and also shorting a call. But I do that sometimes, but it's primarily shorting the put. Now, there are others. Okay, a lot of people, if you go on CNBC and they're talking about call option activity, they're almost always talking about buying call options. And I think right now in the news is Nordstrom. If you think a company is going to really, really do well, buy a call and you'll do really well. Though that's true, statistically speaking, it's not. It's like buying a lottery ticket. If you get the lottery ticket, if you win really big, but chances are you're going to lose. It's 100% loss. For most people buying the call options, that is the same thing. So we do the opposite. We sell you the call. We sell you the put. Another strategy is the covered call. Very not exciting. It's an income strategy. That's not really what we're recommending here. So now, if the market suddenly turned and got bad, we could reverse the strategies, short the calls, buy the puts, but that's not what we're doing really either. Now, I want to introduce, this is the strangle, but I want to introduce you to the concept of theta, which is time decay. When you are short an option, the position loses time value every day, and we model that, and that's good. So when you are short a call or short a put, you lose value. But remember, you want to lose value. You want your position to collapse to zero because you are short. And these are just more option strategies, but what we really want to do is the upper right-hand corner, the short put. This is the beautiful strategy. What you've seen before are lines, but in real world, it's curves, because until maturity, it is more mathematical based on what's known as the Greeks, the delta, the gamma, the theta, the et cetera, et cetera. So, and a true option trader should know at least the basic Greeks. This is, again, the short strangle, but you can see the curves again, and the curve is the delta, which, and then you get the time value. Now, let's say you have a $500,000 cash account. Let's say we're only talking about 5 years. Let's say your option return is 60%. Maybe it's 50, maybe it's 70, maybe it's 80, but let's just, for the purpose of conversation, 60. If you use a financial calculator or an Excel spreadsheet or whatever you're more comfortable with, and you do a future value calculation, that will be worth $5.2 million. Note, though, that this excludes the fact that you do need to pay short-term capital gains taxes on that. I would say on this particular one, the QQQ, the expected range is 59 to 86, and I'm going to prove that to you in 1 minute. As Guy said, this must be done, for all intents and purposes, it must be done in a taxable account. The government disallows the use of margin in retirement accounts. Technically speaking, it can be done in a retirement account, but then it's called a cash secured put, and it is just not worth it. The return is driven down to maybe 9% per year. It's not worth it. Okay, let's do a sample trade. This is a real life trade, but it was done as of June 25th, and the data was right from the OIC website on 6/25. On that day, the QQQ, which is the NASDAQ, was 332. The expiration was June 25. I usually do about 25, 30 day. The shorter you go, the greater the annualized return. The bid premium, remember options trade in units of 100. So if it says $1.71, it's really $171. The strike price, I select based on what I want the delta to be. At this time, I wanted the delta to be 1349. And there are 5 Greeks, I use 3. This is just a little graph of the triple Q. Triple Q is doing great, by the way. Okay, now, there are multiple formulas, but I'm not, we can provide you with the formulas. I don't really want to bog you down with the formulas. So the margin requirement was 4,791. Assuming full profitability, and again, I can show you the formula to get to that. It's $171 in 29 days. The return on investment calculation annualized is 44.92%. The mathematicians out there that are listening are saying, okay, that's fine, but I thought you said 60%. Hold on. So let's look at 4 scenarios. If it takes the full 29 days to achieve the profitability, you will get only 44.82%. This is very unlikely. At the other extreme, if the market does really well, really fast, and you achieve profitability in 8 days, your annualized return will be 162%, probably also unlikely. What is likely is it will be between 15 and 22 days. So the probable range is 59 to 86. And then the model I used, 60%, is on the low end. The probability, once again, this is quite simple and important, is simply 1 minus the delta. So this means there's an 86.51% probability that you will get that 59 to, what did I say, 86%. Now, the more you get into this, you'll see that that delta is not a constant. It is changing, but we also have a formula to model and measure that. Now, there are many things we haven't really discussed. Black-Scholes model, they won the Nobel Prize Award in economics in 1997 for pricing options. It's a very good model. There are, years later, we have learned that there are actually flaws with the model, but that's okay. Risk management, we touched upon a little bit. We talked about closing out the position at a 35-40 delta and how to manage a margin call. I would make this comment. A lot of option traders, it's kind of like cryptocurrency and Bitcoin that get so excited and lured into the high returns, but it's kind of like a lottery or a casino. I recommend not including emotion and being drawn into just the return, but I recommend methodically approaching this, the risk, the return, the tax liability. The next comment, so I'm not saying don't use Roku, Net, and Chewy. In fact, currently we are using Daku and what was the other one? Whatever.
SQ Square.
Thank you. Square Financial, right? And they're doing very, very well. I'm not saying don't do these. I am saying if you use a higher risk position, be aware of the risk. Be aware of the risk. For example, yesterday, Daku rallied 20% on the stock. The option was through the roof. Today, it's down 8%. So just be aware of that. Short-term positions earn more than long-term positions. Higher volatility positions earn more than lower volatility positions. higher delta positions earn more than lower delta positions. There are many, many, many correlations with all of these variables. The theta effect on a short position. So like we say, I guess I would say this, theta to a short option trader is your friend because it accrues to your benefit. And in fact, when you have an option portfolio and you go home, like let's say, and your account settles down at 7 o'clock at night and you see your balance, when you wake up the next morning, your balance will probably have increased a few $1,000s more. Why? Because the theta continues to decay overnight. There's a theta effect overnight. And let me just show one more thing while we're here, though. On our website, these are quantitative formulas and frequently asked questions for those who are interested. But what I'm going to repeat is that please keep in mind, if you do this, what the return is, what the risk is, the probability, 1 minus the delta, very easy. Quantify everything and keep in mind that there will be a capital gain, short-term capital gain tax. And we have, I guess that, I think that, Guy, do you have anything else to say?
I mean, we do have a few questions from the audience. If you want to tackle those right now, we can do that.
Sure, we'll try.
Let's see if we can stump you. All right. So one of the first questions we had out there is there any kind of sources that you recommend for trading terminology, like a trading dictionary, either online or websites or something like that, that you'd recommend people can get a little education?
Well, there are many, many sources. So, so I would say if somebody wants to learn, the CBOE.com and the optionseducation.org websites are designed with tutorials, webinars, and all of that. So if you want to know how to do a covered call, which I don't recommend, but if you want to do that, you can find, plus even on YouTube, there are many, many, many subjects on all of these topics.
Okay, good. I guess along the same lines, another question we had is there a place that you can go online to model options and to take a, different scenarios with different strikes and that kind of thing?
The software that I have found is way, way, way complex. So I bought it years ago. I didn't like it. It was way too complex. So I make up my own. I use, as you know, Guy. So I have a simple spreadsheet. I model the delta, the gamma, the theta, not the vega, not the rho, and it's quite accurate. So I don't like the software that's out there.
And I'll add on to that too. If you are approved for options trading at whatever broker dealer you use, a lot of times on their website they'll have an options calculator you can use to run some scenarios in your account. But typically you only have access to that if you're actually trading with them. So
right.
Fidelity, I know that has that option, but I'm sure Schwab and TD and all of them have the same capabilities. Let's see what else we have here. And real briefly, someone wants to know the Greeks, kind of what they are,
Sure,
and what they mean.
Wonderful question. So there are essentially 5 Greeks, and they're called the Greeks because each is designated with a Greek letter. The delta, it's probably the biggest and most famous one, is the change in the option price relative to the change in the stock price. The gamma, I'm just giving like a simple, if anyone wants a more complex, like the math and what have you, I'll be happy to get into that. But the gamma is the rate of change of the delta. So it is actually the change in the delta over the change in the stock. But it's sort of like if you took high school calculus and you have distance, speed or velocity, and then acceleration. The speed is the delta. The acceleration of the speed is the gamma. And so that's what gamma is. Theta is the time decay of the option. Every day, the option will lose value. And to the short holder, that's wonderful because we want it to lose value. And it also loses value at an increasing rate as we approach expiration. And again, once again, it's kind of fun. You go to bed at night and you wake up in the morning, theta has worked overnight for you too. The next one is the vega. The vega is the sensitivity of the price of the option relative to the volatility. This is one of the few Greeks where if the volatility rises, they both rise, or if the volatility falls, both the call and the put both fall. This is a little unique. And the last one is the rho, R-H-O. Not terribly important, but nevertheless, it's the sensitivity of the option relative to a change in the interest rate. And when we talk about interest rates in derivatives, we are talking about risk-free rates, not risk-adjusted rates. So like government treasury rates.
Okay, good. And the final question we have right now, unless there's any additional coming through, the final one is for someone that's brand new to options. They're familiar with the stocks and bonds, but they're brand new to options. Where would you start if you wanted to start doing some trading?
Well, first of all, good question. But if you, I caution using real money on a dangerous strategy. That I don't want anyone. You might want to practice, but I don't want you to suddenly lose $10,000, $20,000, $30,000 because you didn't notice that the delta had reached 50 or 60 and now it's too late, So I would say optionseducation.org is good. And again, CBOE, these websites exist to help people at all levels, beginning, intermediate, and advanced levels in learning options. And in fact, years ago, the CBOE used to have live instruction. I remember driving down to Hartford. They don't do that anymore. It's all online now, but they still have like webinars for all levels, beginning, intermediate, and advanced. So CBOE and options education, and again, just plain YouTube, if you want to say introduction to options, many sources out there.
All right, Guy, I think we have time for one more.
Yeah, and I think one more here that came through is if someone who's starting to trade options, what's some of the biggest mistakes people are making trading options?
Not quantifying, not understanding the return on investment, which is profit over margin, not understanding the various quantification of risk, which is the implied volatility, the historical volatility, the delta, not understanding what's called capital at risk, which is the maximum you can lose. And I think you always want to know what your risk position is and what your returns are. I think people like buy a call, sell a call, and hope for the best. I don't know that they're modeling and have expectations of what's going on. So I would say if you're going to model, if you're going to trade options, you really need to have a model, and you really should quantify all of these things. So that would be my recommendation.
Well, thank you so much, Howard and Guy. Thank you for being our speakers and presenters today. We want to thank the organizations that have worked with us to bringing this webinar today. Thank you so much for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that replay with your friends or family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming. We will see you at another webinar soon. Bye, everyone.
Bye-bye. Thank you.
Thanks. Thank you, everybody.